bring in our panel. Joining us now, Brookings Institution Economic Studies Senior Fellow Wendy Edelberg and American Institute for Economic Research, Monetary Economics Managing Director Lydia Mashburn Newman. Welcome to you both. Wendy, I mean, I know you haven't kind of been able to dig into the guts of this report, but it seems like a pretty benign reading. How do you feel about it?
Yeah, it's frustrating because they haven't even posted the information that I would need to really parse all of this, given the confusing way they've displayed the information. But the important number is the year-over-year change in the prices of core goods. And that was 1.4%. And that may not sound like a lot, but this is a category that in normal times has negative inflation all the time. And this is where we're seeing tariffs. So I think this is the category where we know that tariffs are having, in some ways, the absolutely expected effect on inflation.
Yeah, so for that subcomponent of inflation where you would be able to isolate perhaps the tariff effect, maybe we are seeing it, although, Lydia, I guess not necessarily feeding into, by this number, a broader lift in CPI.
The headline number definitely seems to be a step in the right direction, coming in at 2.7 year over year. We should keep in mind, though, that that's on some higher inflation numbers that we saw with the Federal Reserve's last rate hike cycle starting at the end of 2024. So we would expect these upcoming readings from November and then December and January and February to look a little bit better because their relative year-ago comparison was also relatively high. But as Wendy was saying, those goods prices are definitely an indicator of inflation showing up in tariffs showing up in inflation. But we still need to keep an eye out on services inflation. While we have seen housing come down a little bit, services are still elevated. And that is a monetary issue. That is related to the Fed's monetary policy. And so we do still have some pent up price pressures from both the Fed's last rate cutting cycle last year and even some overhang or maybe hangover from their post-COVID policies.
Wendy, given that we are able to, identify perhaps this tariff effect in core goods, what does it mean on a forward-going basis? Because you do hear some folks who are kind of, inflation doves who are essentially saying we're going to, anniversary the initial tariff effects and it kind of will come out in the wash. So what's your expectation for how inflation tracks from here?
I don't think we've seen the last of the tariff effect by any stretch. I think we're only seeing a modest part of it so far for a whole bunch of reasons. One of which is that firms hoarded inventory ahead of the tariffs and are probably still working through that. So I think tariffs are going to continue pushing up inflation through 2026 and maybe even into 2027. And then at the same time, by my reading, the labor market is just a tick soft. I think that the monthly payroll employment gains of around 20,000 a month are just slightly below what my estimate is of the break even, given what I think immigration is doing to labor supply. So what all that means to me is I think we have more inflation in train, and I am very, very puzzled by market expectations. Markets right now are expecting the next Fed chair put in place by President Trump to cut by a sum total of 40 basis points. My guess is if that came true, President Trump would be incredibly disappointed in his Fed chair pick. So I think we're in for lower interest rates, higher inflation.